Greetings, everyone. I'm David Darst, here to give you a recap of the month of March, which has just ended, as you know. It was a month of pretty decent returns for financial assets. You had economic growth, pretty stable. Most importantly, the inflation data, which the Fed's been watching very carefully, were sort of to the moderate side. On Friday, the 29th of March, the headline Personal Consumption Expenditures Index was up 2.5% year over year, and the core 2.8% year over year, which were in line with the market's expectations. On a month-over-month basis, both of them were up 0.3%. The Federal Reserve, as you know, in the month of March, had a two-day Fed meeting at which Chair Powell indicated, even though the economy is doing well, that they plan to cut interest rates probably 3 times during the remainder of this year. The chances, according to the Fed Watch tool of the Chicago Mercantile Exchange, of a interest rate cut at the June 11th, June 12th two-day meeting would be 61% of a 25 basis point decrease at the June meeting, and only a 31% chance right now of no change. Also, artificial intelligence enthusiasm continues. This is broadening out not only to the tech sector, and I would say a theme that I would want to bring to your attention in the month of March is broadening. You are seeing equities prices broaden out as the month progressed. The S&P 500 closed at 5254.35. It is now up over 10%, 10.2% thus far this year. So you've had the first 3 months of this year with a very, very strong performance by U.S. equities, and it is beginning to broaden out, as I mentioned. NASDAQ was up 1.8%. It's up 9.1%. You may recall last year, NASDAQ was significantly outperforming the S&P 500. Right now, the S&P 500, which is a broader index, is outperforming NASDAQ. The Russell 2000, they really had a great month. They were up 3.4%, even though they're behind those other two indices, up 4.8% year to date. But they had this is part of this broadening out. Russell 2000, as you know, is small and mid-cap companies, which are really the core, the heart of the U.S. economy. Oil was up 6.7% for the month. West Texas Intermediate, $83.17 per barrel. Oil is up 16% year to date. As you know, during the month of March, the International Energy Agency came out with some revisions to the demand side, where they think the demand might be a little bit stronger than they had earlier projected. And on the supply side, maybe a little bit less than they had earlier projected. You even had an OPEC Plus member, Iraq, cutting back a little bit to make up for an overproduction earlier. So you're seeing some degree of order and discipline to that market. Gold was up 8.4% for the month. Gold is now moved into positive territory for the year. The 2-year Treasury was basically, interest rates fell a little bit, 5 basis points in the month. And 10-year Treasury fell 5 basis points also. So you had interest rates come down slightly during the month. The 2-year Treasury is giving you 4.59% and reflects interest rate expectations of monetary policy. Now, John Templeton, the famous investor who passed away in his late 90s, he had this saying that we've always incorporated into our investment thinking and our investment philosophy. Bull markets are born on pessimism. They grow on skepticism, they mature on optimism, and they die on euphoria. And I would just point out that equity markets are somewhere probably in the optimism category. We haven't necessarily, there are some signs of speculative activity, but it's not widespread or all-encompassing at this point. But we are definitely in a somewhat of an optimism zone right now, not yet euphoria. So that means we need to be extra careful. You see, volatility is very low. Bullishness is relatively high. Volatility not only of stocks, but volatility of bonds, volatility of currencies, volatility of the euro, volatility of the volatility itself. That's the VVIX measure. We do expect, as I mentioned a moment ago, rate cutting to begin around mid-year. We look at our asset allocation thinking, and we favor moving from this 60-40 model, which is 60% stocks, 40% fixed income, to take some of each of these two and devote it to alternative investments. Basically, we would be looking for collateral-based cash flows. We think these alternative investments can give you yield in the form of income yield and also in the form of capital growth yield. They also give you, I think, a reduced level of volatility since they're not subject to the vagaries and vicissitudes and volatility of equity prices. And we would be saying be opportunistic in the credit sector and basically to have a balanced view of duration in the credit sector. That means spread it out over different maturities. And finally, opportunistic in private real estate. And again, taking a look at secondary offerings of partnership units in private equity funds. With that, we wish everyone a great continuation of this year and look forward to catching up with you very soon.